Okay, let's do some questions from the last market outlook. Great example on the car financing. They basically make you pay for it one way or another. A lower interest rate, where you'd need to amortize in the extra dollars up front to calculate the true interest rate you're paying, or a nominal interest rate, call it 8% or something. Um, that is correct. You're not actually getting a deal. When you go to the dealership and they see 2.9% financing, in the price of that vehicle is the present value of the difference between a market interest rate. So you're actually paying the market interest rate. If you went to the bank and you got pre-approved for a loan and you went to the car dealership, say, I'm paying cash, you can negotiate, and they pretty much offer it to you almost right away, the discount for paying cash versus financing. And then you can either buy the vehicle at a lower price and pay higher interest cost, or buy the vehicle at a higher price and pay a lower interest cost. It's the same money. You're not actually getting a deal. It's just a lie. It's called marketing. That's all it is. It's just marketing. For a grid play, you'd want to be in aluminum, not copper. Power lines and substations are composed mostly of aluminum, downstream of the power lines and stations where copper starts to dominate. Okay. Most of the things you buy appear to be in the value style. Yeah? Do you not hold growth companies? Not directly, no. Externally, again, I have a significant amount of my wealth is managed externally. That does all sorts of things. So I stick with what I know best, and with the judicious use of puts, with the receiving of a healthy dividend, and an underlying with a very tempting valuation, you can do just as well as a growth stock without the volatility, and without worrying every morning that you wake up and the story's over, without the stress of at times momentum investing. So I kind of like where I play. LSEG says Juniper's earnings is Tuesday 25th when it's actually the 25th of July. But LCG was correct for last week's ER schedule. Yeah, you'd think they'd be able to get it right. Position sizes. For your portfolio, you hold the REITs. You also sell puts using margin and making it beta neutral by shorting SPY. To some degree, yeah. Can I ask how you size your put selling? Right now, for the Canadian REITs, because it's such high conviction, I just eyeball it. I want 50, I want 100. It depends on how I feel. I don't really calculate a position size on this one. I'm well above the position size I would normally hold for a particular stock and a particular sector. I just make it up as I go on this one. There's not a lot that I think about. When I'm in high conviction, I sell puts 50 to 100 at a time. When I'm in low conviction, 10 to 25 as a starter, especially for something I've never tried before or something I've never played before, where I think, this is not bad. Let me try it out. Let me see how it behaves. I might do 10 or 20 or 30. And then I'll either add to it or I'll say, okay, that's all I'm going to do. Let me just take my loss here. I was wrong on this one. Not until I get really comfortable with it would I then move to 50 to 100 at a time. So I don't really, I'm beyond the point of where I would size things. If I only had, let's say, 100,000, then yeah, I got to worry about sizing things and diversification. But I'm insensitive to that to that now. I think productivity and costs would be an interesting economic report. Productivity and unit labor costs will likely be a big story for near-term inflation, longer-term inflation. Yeah, it is unit labor costs that are more inflationary than labor costs. Because if you have really good productivity, it doesn't matter if your wages are rising at 8% a year. If you have productivity at 6% a year, then your unit labor costs are only increasing at about 2%. That's the target. Just wanted to confirm that the old applied series bundle is the same as the applied level for the purpose of being grandfathered into all included new positions. So if you paid anything for the applied series, then yes, you're grandfathered in. But there's a series I did do originally, just called applied. The applied series is a series of like 30 different videos that are just included in when you subscribe with level 1 or level 2 or level 3. You just have access to that. That's not the applied level at all. So if you've never paid for anything, if you've never subscribed for anything, then you have that old series. But all you have to do is just look at what your content is. If you have sector studies, if you have portfolio construction and applied options, if you've got that, then yes, you are grandfathered in. If you don't see any of that, if you don't see anything called sector studies or portfolio construction, then you don't have the applied level. Applied level. I'm one of your CFA level 2 students. Specifically, I would like to confirm whether all the concepts you will be teaching in the series will cover the basics, or if they will be presented from practical working perspective, assuming prior knowledge. No, they don't really assume any prior knowledge. Not really, no. I mean, I do make some assumptions that you know what a balance sheet is and you know what an income statement is and a cash flow statement. So if I'm in the sector studies using a company as an example, and I'm on the balance sheet and I'm saying, or the income statement, I'm saying here's the gross margin. I'm making the assumption that you are aware of that you are aware of what an income statement is, you're aware of what the gross margin is. So I do make some assumptions that you do know what those things are, because I can't start from zero every time. But if I'm introducing a sector, I make no assumptions that you know anything about the sector or that you know anything about the sub-industry. But that you are at least aware of what financial statements look like. So I do make that assumption. Do you own the applied level outright, or is it partially owned by Serify? I own it 100%. 100%. Will that change in the future? I don't see it changing in the future. I need something, right? When I sold the business, I felt that it was time. Plus, I needed to give employees some growth opportunities, or you lose them. So it was the right time. It was the right time to sell and hand it over to a business that could scale it even more than I could. But it leaves you empty. You've lost something that was your identity for such a long period of time that you wake up and there's nothing to do. Well, I mean, there's things to do, but it's not the same. You've lost something. I don't know that I would do that again. I don't know that I would sell again, because you lose a part of you when you do it. At some point, maybe I'll have to make a decision, but I don't see an exit as an option on the applied level at this point. From where I stand, I mean, that could change in 4 or 5 years. I mean, I could contract some kind of illness, and I am at that stage of life where you have to start thinking about your own mortality. I could say, look, I've got 3 or 4 good years left. Do I want to do this for the next 3 or 4 years, or is it time to hand it off to somebody that can continue it? I think under those conditions, I would consider that. But as a healthy person, No, I don't think I would. Again, because of the emptiness it creates, and it was, it was, yeah, post-sale depression for a while until you figure out what you're going to do. What's your rationale for selling rather than purchasing to establish your position? If I sell, I win both ways. If I buy, I only win one way. So let's say I buy a call, and let's just do a little stock chart. It's right there, and I say, okay, well, I'm going to buy this call. I only win if it goes up, and it goes up by more than the premium. So it has to go up by the strike price X plus whatever I paid for the call, and that would be my break-even point. And then I start making above that. If it doesn't go up, I lose. Whereas if I sell a put, especially on something I want to own, let's say I'm watching a stock and I think, well, I wouldn't mind buying that. Well, then let's sell a put. If I sell the put and it drops, I will have bought the stock at a lower price than when I had decided that I wouldn't mind owning that stock. If it doesn't go down and it goes up, I made money just by saying that I would buy it. And then I can sell a put again, and again, and again, and again, and again, and again, and again. So, for example, in 2023, my second best performer was Oxy. Never owned it. All by selling puts, the 5750s and the 55s. And I was selling 50 to 100 at a time. And it ended up being my best performing holding without ever holding it. AT&T, never had it put to me, and I've done fairly well on AT&T. I've done better on AT&T by selling the puts 50, 100 at a time than I would have had I originally bought AT&T, considering the margin that I use, using that instead to buy the shares. I wouldn't have been able to buy 5,000 or 10,000 because the margin to sell 50 or 100 puts is less than actually buying it. So the difference between, let's say you bought 10,000 shares of AT&T, it's going to cost you $170,000, but selling 100 puts is not going to take up $170,000. Just for the hell of it, I'll calculate what it would cost me here. 17 times 0.3, 51. It would have cost 51,000 instead of 171. So you got 119,000. That then earns the money market rate of return as opposed to being in AT&T. Plus, you're getting the premium on the puts, and you could do it again and again. So, like I say, I've done better by selling the puts than I have by actually just buying the stock. And if it is put to me, I buy it at a lower price than what it was trading at that time. Even if I really want to own it then and there, it's still always better to sell a put. So let me give you a good example. Let's say GM. GM is sitting at around 46.50. It's had a tough couple of days. And let's say I really wanted it. I'd go out to July and I could sell the $50 puts. I'm going to get at least $350. But you'll probably squeeze out from July here. You'd probably squeeze out maybe $390, $380, $390. And as long as it stays under $50 by July, I will have it assigned to me, but I won't be paying $46.50. If it's $390, I'll be paying $46.10. So I can still buy it cheaper by using the put, a cash secured put, and just waiting until it gets put to me, than I could just by buying it outright. Now, if it goes from $46.50 to $49 by the time July comes around, I still get to buy it for $50. My average cost is still $46.10. I've still made the increase. The only time that I would have been better off owning it is if it increased above $50 by July, which I don't think it can. It's had a good run. I don't think it's going to do much until it has its Q2 earnings and the seminar from Cox Automotive. The live seminar yesterday for the second half outlook kind of has a flat second half outlook, but Cox Automotive does expect that GM will be the winner this year in terms of sales, in terms of market share gains. So projecting out a flat second half. And that's why I don't think it's going to break $50 by July. But if I wanted it assigned to me, that's what I would do. And I'd still do better than buying it outright. You can always do better buying and selling using options than you can with the underlying in aggregate. Not every single time, but in aggregate, you can always do better. You mentioned in previous videos you're in favor of going long December CME. CME. No, I've never once talked about the CME. CME is a stock, a futures contract. But what's the difference between this versus TLT call options for similar strike and expiration date? You got me there. I don't know what the CME futures contracts are. Difference between this versus TLT. The closest futures contract to TLT would be ZB, which is the 30-year bond contract. The duration would be fairly close between these two. This would probably eke out a slightly better duration. Although I don't know that you'd go to December with futures. You got to play the front month. There's no liquidity for Treasury bond futures. Usually you'll have 3 that are listed with nothing going on the back contract. The middle contract, wide spreads. All of your liquidity is in the front month. So you'll be rolling your contract. TLT, you can buy, whatever shares you want. ZB, the underlying, keep in mind, is a generic $100,000 6% coupon bond. So the futures price on this right now is about 116 to 119, depending on where the bond is. That's the closest. But I don't think I said I was going to go long the ZB contract. I'd be more likely to sell puts on ZB if I see it like around 114, 113 to 114. I'd probably sell at the money puts at 113 on ZB, but that would be about it. Also, IYR puts versus TLT puts. Any reason you've gone with IYR? Well, these are two separate things, right? TLT are bonds, treasury bonds, 25 or 20 to 30 year bonds. IYR are REITs. They are different things. TLT, since they're using coupon bonds for this, the only real thing that matters for TLT is the denominator, which is R, whatever the spot curve does, which will be a reflection of the par curve. But for IYR, R is a factor, but you also have G as a factor, and you have net operating income and the growth in net operating income. It has both a numerator and a denominator, and R is only one factor of the denominator. So that would be more on valuation than anything. How do you go about choosing in the money versus out of the money leaps? I don't know. You tell me what you're trying to get done, and I'll tell you what I would consider. Beats the hell out of me. I mean, there is no rule for that. It would be like me asking you, how do you go about choosing what you're going to have for lunch tomorrow? And your answer would be, I don't know. Depends on how I feel. Am I eating at home? Am I eating out? What restaurant am I eating in? What are the prices in that restaurant? Am I on a diet? Am I not on a diet? What am I trying to get done? Am I with friends? Am I alone? Right? I mean, there's no rule. It's like, check with me tomorrow and I'll tell you why I did something that I did, but I can't tell you what the calculus is for doing what I'm going to do. So if you said, okay, do some leaps tomorrow, what are you thinking? I said, I don't know. What's the underlying? What do I think is going to happen? What's the purpose of me doing it? There is no give me a scenario for so many things in the market. If somebody can say, well, this is what you do, it's like, well, I don't know if they're experienced enough when they say this is how you do this. It's you give me a scenario and what you're trying to get done, and I can give you some options, or I shouldn't say options when I'm talking about options. I can give you some alternatives on how to use the options to get it done. But with no setup, with no premise, and just the question, it is impossible to answer. Compared to 5, 6 years ago, would you say you spend more time researching new themes? Yeah, a lot more time. In your live Q&A, you mentioned you used to do 14-hour days, but I assume a lot of that was building. A lot of that, it was all of that. All of that was building the business. All of it. Every minute, every free minute of the day was that. Every free minute of the day for, it was like 3.5, 4 years straight. And then the pandemic hit and I got a little bit of freedom. And then it was hard to go back to that prison. Building a successful business is a prison because, the moment you start to enjoy your success is the moment the business starts going sideways and even dropping. It is successful only because you do what you do. Most people, just look at the outcomes. People who have never built a business before only look at your outcomes and they envy your outcomes. But if they looked at your process, they would not envy your process. They would not want to be you in that moment because there is no life. That's if you care, right? It is a sacrifice. And it takes a toll on you. It takes a toll on your health. It takes a toll on your body. And you may not think so. You're just sitting there, but you think it through, right? And what you have to do to get things done. And let me tell you, your body is pumping cortisol every single day. That shit will age you. Do you prefer to sell puts during bear markets as well? I do. During bear markets, when things are really, really dropping, there's where I don't, I'll be selling puts and buying calls at the same time. I'll step into risk reversals as opposed to just selling puts. Because when it's really, really dropping, that can't sustain itself. When there's really heavy selling and every day it's down, 2.5%, 3%, you get these market sell-offs that last, 3-4 weeks. Where it just seems there's no bottom. Those can't last. That at some point in there you're going to start doing risk reversals. Is the Phillips curve still useful? Was it ever useful? What did the Phillips curve tell you? That there was a trade-off between inflation and employment? That's really all it told you in one data set from one country at one period of time. Almost never replicated ever again. The Phillips curve, I think, is useful for, let's say, a country like Canada, less useful for a country like the US. Canada has a productivity problem, so there will be a definite trade-off with inflation and unemployment. Inflation and employment. But if you have high levels of productivity, if you're a productive country, then there is no trade-off. You can have high levels of employment with no inflation. There doesn't have to be that relationship. So there's a missing variable in there that, if you look at the context in which it was studied, it was like, well, what was missing? Productivity was missing at that time. And productivity 60 years ago was much harder to get than productivity is today. Productivity was because you had a much more manufacturing-based economy with not a lot of technology. So productivity, it may have been useful in non-productive countries 50, 60 years ago, but in highly productive countries on the cutting edge of technology, it's not useful at all. Are we going to see sector rotation now? Not a clue. IWM has not seen much growth. Is it time for IWM to follow the SPY trend now? Well, IWM also includes unprofitable companies. SPY does not. When you have unprofitable companies, high interest rates just keep making it unprofitable. So you have a larger proportion of unprofitable companies. And this is sort of why small caps haven't really followed, is they're not as well placed on the balance sheet as large caps are. Their cost to capital is higher. So you need lower rates to get much of a bid in small caps. I also wonder if maybe there hasn't been a turning point in the belief was that size mattered up to a certain point, and then after that, size worked against you. That's gone now. We don't have increasing costs to scale. With a lot of these tech companies, you have decreasing costs to scale. That means as you get bigger and bigger, your costs get lower and lower. So it becomes so much more difficult for small companies to compete against large companies for two reasons. You can't match their cost structure, and they become this big black hole because of their network effects. So you're on some of these or with some of these companies, because of their sheer size, because of the network effect that you can get, they're more valuable at larger sizes than smaller sizes. So in certain fields and in certain areas, I don't even know if small companies can even compete and match what a large company can do. I don't know. So it could be that the relationships that we have seen, or the factor returns that we have seen in the past, may not exist anymore, or that require such higher premiums that to induce me to be in small cap stocks, I'm going to need a much higher size premium than what the market previously offered. And for me to get a higher premium, I'm going to have to buy at a lower price. So maybe this is as good as it gets at this time for small caps. Do you remember the name of the Clemson professor you referenced in the Q&A? No, but Clemson University has a Center for Automotive Research, and it'll be someone in there. So I'm sure if you Google a combination of Center for Automotive Research, Clemson University, AV Research, you'll hit something. When do you think you'll post your video in Applied series on how to build ads with the motorist volume? September. I say it every time. September. So to answer your question, I'll be posting it in September. Since there's a major escalation in conflict around the world, can you do a sector studies on aerospace and defense? Is there potential opportunity in this area? There always is. Always. The natural state, I think, of humanity is conflict. The natural state is conflict, and wars happen all the time. Try to find a day in the last 100 years, 200 years, where there was not a war going on somewhere in the world, where there wasn't a civil war or a regional war or a proxy war somewhere in the world. There's always a war going on. Always a war going on. So there'll always be a market for that sort of thing. The question, I think, going forward is what is going to be the market for armed conflict? Is it going to get larger or smaller? And they're trying to think of the book. There was a really good book that talked about this from an economic perspective. and I forget what it is now. But it talked about cycles in terms of wars, and that there are these recurring cycles that happen. Is that in usually in difficult times you end up getting much more autocratic leaders. And what are we seeing in the world? We're seeing a move away from the center. This is where you want to be. We've had too much on the left, right? And instead of coming back to the center, we're going to overcorrect, and you're seeing it move. You're seeing it move the other way, and that some of these people over here tend to be a little bit more autocratic. Not that you can't get autocratic leaders on the left. I think some of the worst leaders in history have been autocratic leaders from the left. Stalin, Mao. Think of Castro, any Venezuela, right? Any of these socialist countries, the really evil stuff happens in the extremes, right? And we're sort of, we want to be in the center. You can only swing from one extreme to another extreme for so long. This extreme here has got a bit of a problem as well, right? This extreme here has a focus on immigration and the ability of a state to absorb the level of immigration that it is, and it will erect barriers to entry. But you have a world in which, let's draw a circle here, there's the equator, in which living under here is getting harder and harder to do because of the growth that you had up here over the last 100 years. You had the Industrial Revolution happening up here, but you have climate change really affecting the southern region more. So there has been migration northward quite a bit. You don't see it going the other way. You're not seeing migration from north to south. It is from south to north. If you have this starting to dominate in the world, you're going to get rising tensions, rising hatred, rising conflict, which means that the market for armed conflict may increase. And if that's the case, then yeah, there could be opportunities in aerospace and defense. But there's always been opportunities in aerospace and defense. Curious on your thoughts. Curious about your thoughts on the talking heads on Bloomberg. Watching its shows over the last couple of days, it strikes me how fast the topics move day by day. If you listen to the show for 1 or 2 days, it feels like everyone on the street focuses on a particular concern. 2 weeks ago it was the inflation report, last week AI, index concentration. Now almost all the interviews today on Wednesday talk about economic slowdown, tipping point. Yeah, it does tend to do that. However, the AI conversation could go on since the issue is not resolved. Really feels like an agenda. Change the topic so often and get so many talking heads on that the audience feels that there is so much to worry about and things move so fast. It's worth tuning in. I don't know that it would be an agenda as much as if you're going to keep the attention of an audience, you have to, you can't just, it's not the place for long form interviews, right? It's talking points, it's minute to minute to minute. So, my recommendation is when you're watching Bloomberg, don't get too much into the analysts in terms of what they're saying on the spot, because they'll have some on, we see the market going higher, some, oh no, I think this is it, we're overextended. Like, everyone's got an opinion. The one thing you can take away from Bloomberg every day is nobody really knows what's going on. Nobody really knows. So forecasts, I tend to ignore them. We think the market's going here, I tend to ignore that. when they have analysts on talking about a position, I tend to ignore that. They had one on the other day justifying, talking about a price target. And they started by saying, if you consider this company and this product only, yeah, you can't get to their current valuation. So that's why we consider these other products. It's like, well, aren't you doing that backwards? You're taking the valuation as given and you're saying, okay, this doesn't get here, so let's try to get there from these. Shouldn't you bottom up it and come up with a valuation? The other thing you'll notice is probably 30% of the statements given by some of these people are just, they're wrong. They're simplistic statements, or they're just wrong statements. It kind of makes me wonder, now that I think about, why do I listen to it so much? I listen to it because every now and then they have somebody good on. They have, or somebody makes a point about something, and I think, okay, well, that's an interesting point. But a lot of it, I'd say 90% of it is just filtered right out. It's just the noise of the market. How do you manage the news flow and stay on top of things while not getting biased? I don't really listen to them too much. Yeah, I think the best time is 7 to 9. During the day when the market is on, it's not that interesting. 7 to 9 is pretty good. You get a good idea of the headlines and what's going on in the market that day, the tone for the day. But during the day, I don't know that there's much value in it. Digital nomad living the dream on work from everywhere in affordable countries of Asia and Latin America. The main message for your audience is, do not top up your IB account from different countries, even if IB accepted your change of address with supporting documentation. At some point they will block you and require you to close your account, as they did with me. Okay. 2 questions. You said that XLU would increase its revenues due to increased assets it would have due to increased power demand, but what about the increased CapEx it would need? That doesn't have anything to do with their earnings. That'd just be comparatively small. Well, it won't be small, but I mean, that CapEx has nothing to do with your earnings. It eventually finds its way to your income statement through depreciation, but CapEx is not going to affect. It's not going to affect earnings. Utilities usually use a combination of equity and debt in increasing their assets. I've followed you for a long time, and you seem like you live and breathe the markets. You do so much research and put so much work in everything you do. How do you then balance your family life? I have no family. With your professional life. Well, I have no family. And when I say no family, I mean zero family. But I, that is an accidental outcome. It's not like I engineered. It's not like I engineered it. It just I never had it. So I don't know that I would say I recommend getting rid of your family. What tips do you have for me as someone in my early 20s to balance my work life and personal life? Balance. I've never been good at that. I have an obsessive personality, so I usually obsess about things that I'm involved in. I don't know that you really have to work hard to balance. Those around you will balance for you. They'll draw you into things, especially family. I guess I don't have good advice for that because I never really had to balance. Like I've never been married, no kids, no parents, no cousins, no brothers, sisters, anything like that. So I've never had to make the choice to balance. But I can speak on a point of regret, and that is my dog. When I was in his last 4 or 5 years, I was building my business, and it took everything in me to do. But you still had to pay attention to the dog. So, it was walk the dog, do work, walk the dog, do work, walk the dog, do work, go to sleep, get up, walk the dog, do work, walk the dog, so there were times where I just didn't have the time to walk the dog, but you had to. So there were times where it built up a little bit of animosity, like, oh God, I gotta walk this fucking dog again, like Christ, and that was the wrong thing, right? The dog should have been the one, that rock in my life, the grounding, as opposed to an annoyance. I shouldn't say an annoyance, but I saw the dog as work and not my business. Yeah. So in the end, when he had gone, I regretted not taking the right amount of time with him. That the only time I took for a couple of years there was when I walked him, and then the rest of the time, I focused on my work, and he did what he did, and that was it. So, find the balance, or later on you might look back and regret a few things there. Don't see the family and your personal life as work. Do you think the Tailor Rule is still relevant in today's economies? Yeah, I do think it's useful because it has the two mandates in there, right? It has inflation and it has full employment in there, and it focuses on you have a nominal policy rate, which is R star plus your expected inflation. So it's the wild card, the unknown, the one thing that can't be observed here is R star. So it's useful in the sense that if you have an economy that you've raised interest rates and your GDP is just not responding, it sort of starts giving you some idea about where could R star possibly be in a world in which you have a lot of financial sophistication. So a lot of hedges are in place, and a lot of products are designed such that they have natural hedges in there, such as the 30-year fixed rate mortgage, right? That if you have a large part of your economy that is immune from interest rate hikes, and then in behind that you have a degree of productivity that can be a function of the interest rate, that the higher the interest rate, you get something called induced innovation, which increases productivity as you're increasing the interest rate. The combination of this probably pushes R star significantly higher. Well, it's within the framework of the Tailor Rule that you can think about that, because you've removed a lot of the variables that you would naturally start to think that matters. Nice thing about the Tailor Rule is it brings your thinking down to a few key variables, and that's what makes it useful. I don't know that the Tailor Rule is prescriptive. It was really never meant to be. It was meant to be descriptive. I don't know that central banks use it as a prescriptive tool. How do you get things like this AV research in your radar newsfeed? I rely a lot on Apple News. If you have a habit of clicking on certain things, you get more of those things. So that if you look at my newsfeed, it is overwhelmed by news about the economy, news about financial markets, news about the stock market, news about business. It becomes overwhelmed with that. So I don't, when I first started using Apple News, I'd get stories about Kardashians all the time, and I never ever clicked on that stuff, ever. And it just kept showing up, and I kept thinking, it's not a very good algorithm. I no longer get that anymore. I have no clue what's going on with those people. Because I never click on that stuff. I never click on all of that other nonsense stuff. I do get a lot of stories about dogs, though, because every time I I see it. I can't help but click click on the stories. And then you'll read one story and there may be a reference to another story somewhere. So you'll click on that, which brings you to a website, which then you'll click on that, brings you to another story. And oh, well, look what I found here. So it's just a lot of following a whole bunch of leads and spending time with the news feed. And you click on one story, you'll read something. At the bottom, there's links to 12 to 15 more stories, and you can read just the headlines of those. And so it's sort of just like a lottery. You get lucky. That's all. And once you get to a certain place, you may find that, well, this place has a regular weekly blog, and they have this. So you can put your email name in there, and then you get notifications every time there's something new up. And you slowly build up your list that way. And so this week, what came in this week? Two auto stories came in this week. Cox Automotive had their live seminar yesterday. So no, you wouldn't remember it, or you wouldn't know about it unless you got the email. The other one I got was Experian Automotive, the Q1 2024 Automotive Market Trends Report is out. It's still in my inbox, but there's a big download the report button. I haven't hit that yet, but on the weekend I'll download it and I'll see what it has to say. So as you visit certain sites, you'll start to say, well, this is rather useful. There's usually always a way to subscribe to the news feed from that site. Experience of Canadian politics ahead of the imminent UK general election is speculation that governing Conservatives may experience an electoral wipeout. Canada's put PCs in 93. Yeah, that was under Mulroney. That was a wipeout. And let's not forget about the other wipeout too. In 2008, 2009, I think it was, the Liberals under Ignatieff got wiped out so bad they weren't even an official party anymore. I wonder if the same thing will happen to Trudeau, leaving the potential for a prolonged period of centre-left government in the UK. What impact, if any, did Canada's political realignment following 93 have on public discourse? Zero. Public discourse? Zero. Nobody even talked about it after. Like no one talked about anything. No one talked about politics. I can't remember a time during the 90s where you got in an argument with a friend or a neighbor because you just couldn't believe that they would vote for that person, whatever that person happened to be. No one talked about it. Rarely did anybody care. It created no headlines. It was rarely in the news. You had to seek it out if you wanted to know what was going on in Ottawa. But no one cared. No one really cared. It's not that way now. I blame social media for that. Social media has given everybody the opportunity to not only have an opinion, but to share their opinion. And not only share their opinion, but the algorithm is set up such that they're made to think that their opinion is absolutely right by all the other stories they get that support the very opinion they have. The public discourse never used to be that way. There never used to be a public discourse. You had to be engaged in it, and then you were part of the discourse. But other than that, it just wasn't anywhere. Now it's everywhere, and everyone's got an opinion, and voices that should not have a voice have voices. And news organizations in the 90s were still news organizations. Now they are profit centers. And because they're profit centers, you have customers. And when you have customers, you have to have customer satisfaction. And you get customer satisfaction by telling your listeners exactly what they want to hear. So from that perspective, CNN, MSNBC, Fox News, they're very, very successful and very, very smart. They're not news organizations. They're echo chamber organizations that have a target market. They know they're not going to get the other side. They don't care about the other side. They tell their listeners exactly what they want to hear, and ching goes the register. But yeah, public discourse, there was none. I could tell you that. I mean, yeah, it was a wipeout, but there was nothing. The next day, no one got into fights with anybody else, or no one was disinvited from a family dinner because of how they voted. No one cared how you voted. And if somebody said, did you vote? Yeah, I voted conservative. Ha ha, you voted conservative. They got wiped out, eh? Yeah, they did. And that would be it. That would be it. It wouldn't be grounds for, getting rid of anybody out of your life, or demanding that somebody lose their job because they voted a certain way. That's today. Today, it's gotten to the point where almost every country, it seems, is, and I think some of the worst ones. New Zealand was bad for a while. I think Australia was bad. The U.S. was really bad for a while. Is most of the Western countries, democratic countries that have a left and a right, for 8-9 years were embroiled in a social civil war. It was a civil war, really, but it was fought on social grounds, not military grounds. I don't know that you've had countries more divided and leaders willing to divide. Trump was very divisive. Trudeau is extremely divisive in Canada, absolutely willing to divide the population. It just never used to be like that. Do you know why the Conservatives got wiped out? It was on one thing, and one thing specifically, which is the GST. It was that tax on everybody that killed them. A little bit of free trade animosity in there, but nobody could see that free trade was going to be good. The initial fallout was a little bit negative for Canada, but it was the GST that killed them. Yeah, it was on policy that they lost, not on popularity. Right? They didn't lose because they were demonized. They lost because the public said, we don't like your policies. We don't like what your government has done. And that was it. That was, Thoughts on purchasing at the money calls for CapREIT with March 25th expiring? Yeah, you could. Yeah, all the way to March, yeah. I guess you could. The risk is you lose what you paid for the calls. CapREIT has to go up by the price of the calls if you're at the money. The other way of seeing it is, okay, so you're buying these calls. You can think of them as free. Let's say you bought a call, and I'm just going to make up a number here. Let's say you paid $3. You're going to pay $300, and let's say it was a $45 call, and you're going to pay $300. If you bought 100 shares, it would have cost you $4,500 if you bought the shares instead. This is your cost of carry is the $300. If you put the $4,500 into a one-year, I don't know, deposit or something, let's say you get 4% over the course of the year. What does that come to? $180. $180. So you are offsetting some of the cost of the call because you'd be earning this. So it doesn't really have to go up to $48 because if this was $3, you're paying $300. So it doesn't have to go up to $48 because $1.80. Sorry about all this dinging, but I just keep getting messages and I don't know what they're for. Oh, Apple notification. Apple is going crazy, sending me good news. Your order is shipped. So you can think of the money on this as being in the cost of carry. And when you look at calls, if we say the price looks like this, calls are centered around the forward price. So if you go 1 year out, the 0.5 delta would be around the forward price. So if you're using a 1 year at the money call, the at the money is actually much higher than where the price is by the amount of Usually it's the risk-free rate minus Q, which is E to the, this is the 1-year rate, this is the dividend yield. Since you have a dividend yield, if you own the shares, you would be getting the dividend yield, but you'd be giving up the money market return. So the cost of carry is the difference between these two. If you think about it that way, you're really not paying a cost of carry. You're really just paying time value as opposed to cost of carry. So sure, I don't see a problem with doing that. Probably not the answer you wanted or too technical, but would you be able to do a comparison of ABR, Annaly, and agency? I don't really know why. ABR is different than agency and Annaly. So agency, NLY for Annaly, and AG and C hold MBS on their balance sheet. They buy mortgage-backed securities. ABR has loans on their balance sheet. These are bridge loans backed by real estate, right? So they're not holding MBS. It's a different business model altogether. It's considered a mortgage REIT, but it's a different business. These are not agency issued mortgages that agency or Annaly would hold. They hold actual bonds. They hold MBS, and they use leverage. So on their balance sheet, you have assets, liabilities. They will have an MBS. Now, they're really only interested in the spread. They're not interested in the interest rate factor. So they'll hedge by shorting U.S. Treasuries, right, to get rid of the interest rate factor. This means that if interest rates go down, the mortgage security would increase, but the U.S. Treasury would increase as well, thereby canceling it off. And the same thing, if interest rates went up, mortgage-backed securities would drop in price, but U.S. Treasuries would increase in price. You're hedging out the interest rate component, and then you lever up the spread. You lever up the spread by using repos on this side to lever up the spread, right? So you're going to get as much, in good times, you'll go up to 11, 12 times leverage. In bad times, you'll bring it down to 6 to 7 times leverage. And then you can determine whether you want to under-hedge or over-hedge your treasury component. That is not what ABR does. All right, ABR makes loans. Different altogether. For a parent in mid-50s, low income, any asset allocation suggestions? No. 200K with max TFSA and mostly an individual account. Income isn't needed at the moment, but some high dividend ETFs look interesting alongside mix of equities. I don't want to get involved in this one, really. I don't know anything about you. I don't know anything about your situation. Mid-50s, retirement is not that far off. You have low income, which means you probably have high standard of living risk. I don't know that you want to be a do-it-yourselfer at this point. Yeah, I'm gonna back off of this one. I would say seek out some professional advice, and not me. I'm not professional advice because for me to give you advice, I have to know a hell of a lot more about you first. And I know nothing about you other than answering your question about what agency and Annaly are versus ABR. The second part is advice, and I'm understandably going to just avoid that question altogether. Thinking of selling 30-day to expiration puts on agency at a 950 strike and on LTL at 91. All right. Do you think increasing the strike price on these from previous strikes is the right move? Yeah, if I were going to do agency, I would seem to think 950 makes sense, because under 950 I'd probably want to own it anyways. I think lower rates are the future. So yeah, I think if they did breach those strikes, it would be just for a period of time. Yeah, yeah, I'd be okay at those strikes if I use those. I'd be okay at them. New triple witching event is all three data providers agreeing on earnings. Yeah, no kidding. It's the trifecta. Uh, how did you go with targets on your watch list, man? Just pick up some GM puts. Looking at the August GM puts for 44, I think I saw 125 in the morning, and I thought, well, yeah, if it holds out there, I'll pick some up. But then the day got a hold of me, and I didn't do anything, so I didn't get anything done today. One question regarding agency. MREITs. Fed has claimed that they intend to clear their balance sheet of MBS, stick mostly to treasuries moving forward. Well, they didn't say they were doing that moving forward. They said that they would do that at some point in the future. That at some point in the future they want to be all treasuries. When you say moving forward, it means like from this point onwards that's what they're doing. If this is a timeline, and here we are, it's at some point here they will start to do that. This will in return reduce the buying pressure on MBS. Well, they're not buying any MBS right now. It's just runoff, potentially keeping the spread between the fixed 30-year, 10-year wider. Yeah. As a result, I could see agency MREITs negatively affected by this dynamic. What's your opinion? No, I don't think so. No, I don't think so. Once interest rates start dropping, the runoff here will increase. At some point, they believe that it would be necessary to sell, but they are certainly not going to dislocate any market in their selling. I noticed the increment of say 1, 5, 10, 30, 100 contracts don't necessarily have a proportionate margin required. One stock that I follow had the best ratio of premium per margin required when I selected 28. I'm on IBKR. Well, that's probably because it was taking into account other things in your portfolio, and you were either increasing from a negative or decreasing from a positive beta position, and it was setting your margin based on other things you have in your account. Do you have an outlook or opinion on the trucking industry? Not really. With the green initiative taking place and semi-trucks transitioning to EV, how do you see this play out? Don't know. Industry is being a downtrend post-COVID supply shock, high trucking rates. Yeah, I haven't spent any time with trucking. What fundamentals do you consider most important, and how do you compile a watch list? The Russell alone contained 2,000 stocks. Russell has 2,000 stocks, but about 700 of them are unprofitable. I don't really play with the Russell at all. I don't really focus too much on those stocks. What do I consider most important? Probably above all is valuation. You know, I don't want anything that's trading at 40, 50, 60, 70, 100, 150, 200 times forward earnings. I don't want anything like that at all. So valuation to me is probably first and foremost. And then from that, why does it have that valuation? And if the valuation is unjustified, then I have a target. If the story supports a higher valuation, I got a target. But if the valuation is justified, then I don't want to touch it. 847, Mexico economic activity higher year over year, lower month over month. How is this even possible? So let's take a timeline. There's year over year, there's month over month, right? So you had a forecast for both. And let's say that you had data that looked like this over the last year, right? And the month came in lower than expected. Maybe it came in here, but you had revisions to previous quarters that looked like that. I believe you already explained why utilities have guaranteed return based on their assets. But is that specific to U.S.? Nope. No. I've been considering starting a Canadian utilities position now that rate cuts have begun. No, it's not. It's not specific to U.S. Different regulators, but same process. I still see risk in cutting. If inflation rips back up, Powell and company will look very foolish. You want to be a Volcker, not a Burns. Okay. When you hedge your foreign currency exposure, do you just buy or sell the front month futures contract? If you're using futures, yeah, you stick with the front month. I'm from Australia and own U.S. equities. I want to hedge against a strengthening Aussie. I want to hedge around 120K. So this mean I should buy two? What's the underlying? If you're buying two, you're saying the underlying is 60 on each. I think it's 100. I think the underlying on the U.S. contract is 100, except the euro I think is 125. So I think you only need one to hedge. You'll be under hedged, but two would be over hedging. Can you give some details on what the financial crisis will look like? No. I mean, details on, you're saying on what the financial crisis, that is a definite article. You're referring to something specific. What financial crisis are you referring to? Would the impact of the disaster change guidance to retail investors of the long-term buy and hold strategy of a diversified portfolio? No, nothing will change the long term. We'll continue to bounce back. Yep, if you're investing for the long term, you can just eye on the prize. 40 years from now, just keep looking. 40 years from now, everything will be better. 40 years from now. So, what is your opinion on externally managed funds in the private equity space? I don't know. I don't know. I do appreciate the diversification benefit and their historical returns above the S&P 500. However, the high fees and lock-in periods put me off. Well, that's the point of private, is they're illiquid, so you better be illiquid, right? And they are illiquid and inefficient, which require active management. You don't get anything for free. You're going to have to pay for that. For U.S. Mexican, is there a positive move in the U.S. economy? Would this not be considered a risk-on event, thus meaning emerging currencies would continue appreciating? If the U.S. dollar weakens, then yeah. If you think positive economic data would weaken the U.S., then yeah. Yeah. In the last Q&A, you mentioned that the majority of your money is managed externally. How much percentage of your overall portfolio do you manage yourself? That's a good question. 20%, 25%, 20%, something like that. Could you elaborate on why you chose this route over managing yourself? Diversification of strategy. I tend to follow a particular type of strategy. If you were investing in hedge funds, you'd try to find 3-4 different managers, all with different styles and strategies, right? So I can't have 100% tied to just me, because what if I hit a period where I'm really wrong, which is, everyone in their life hits that. That would be bad news, right? Diversification of strategy. Regarding crypto and where it is a solution, used to live in Argentina for a while. U.S. is a must in that country. If you stay there for longer, it is needed to buy pesos at the blue market rate. Otherwise, you pay more than twice for every single price tag with your foreign credit card. Inconvenient alternative is to bring a brick of freshly printed last series dollar bills to convert some of them into pesos for your weekly expenses. Old series or used dollar bills are discounted. Green dollar bills with smaller heads. The founding fathers and bills with handwriting are difficult to exchange. So I've heard this before, and I can say, yeah, that is a use case, but it's too small of a use case. It's not a global use case. There are pockets of use cases here and there, but if you're trying to justify the valuation of the crypto space, these use cases are far too small. and inconsequential. You need a global use case. You need a mass market use case. So you need you need a Visa or a MasterCard. You need like something like Stripe has wide a wide use case. Apple, the iPhone, the internet. You need big use cases. These small little use cases here and there don't create big enough markets to support the valuations that the crypto space has, especially the valuation that Bitcoin has. The market's not big enough. So I'm not saying there are no use cases, but you need a big use case. You need a wide market use case. There is none. There just is none. Or if there is, it's really, really secret. Well, actually, there is a use case that probably covers a good 5% up to 10% of the global population, and that is crime. That is its biggest use case is crime, is for the proceeds from criminal activity or as a means for criminal activity. Probably one of the biggest use cases is crime. But Canada ranks 4th in the world in terms of net inflows of millionaires. What do you make of this? I think I answered that in the live. Your videos and insights and lightning questions regarding January 25th or March 25th Fed Funds futures. I've never traded these futures. Could you explain how much profit one could expect to make per contract if Fed Funds futures were to drop 100 basis points? I think it's like $2,160 per every 100 point. Yeah, you could make or lose to like 100 basis points. It's based on I think it's the underlying is like $400,000. It assumes a $400,000 deposit, and it's the interest on $400,000. I think it's every basis point or every 100 basis points is. Yeah, I'm. It's cloudy, but it's not much. How much margin would IBKR require per contract? I think it's like $2,000 per contract. It's either 1,000 or 2,000. It's really small. Really small. What is your view on office REIT during rate cut cycle? Not good. The only office REITs that I would ever consider would be prime buildings in gateway cities. Would be a Class A properties in gateway cities. So cities like San Francisco, Los Angeles, Chicago, Atlanta, New York, and Class A properties in those cities. Anything else I wouldn't touch. PoolCorp revised its guidance lower again today. There is some strong resistance at the $300 mark, however, expected to break through over the next 2 months. If it's revising its guidance lower, and we're in June, I would not hold out a lot of hope. You don't really install a pool in September or October, right? So I would not hold out a lot of hope that they can pull it off. You need a full season for that, so I wouldn't hold out a lot of hope there. Fortunately, the options are not liquid. What do you think the drivers for outperformance are? Lower interest rates, lower cost of everything. I've been saying this for the last week since I've been back in Canada, looking at the prices of things and looking around saying, I don't understand how people are affording all this stuff. I went to price out a new truck, and I can afford the truck. It's no big deal. But my insurance increases 400%. 400%, $3,400 on this vehicle. $3,400. That's almost that's a 4%, almost 4% of the price of the vehicle per year in insurance. I say, you must be mistaken. You must be mistaken. How could it be this? And no, that's the price. And I look around at all these vehicles and I think, how are these people affording it? I'm rather insensitive to price these days, but I can see the number. I know most of these people have wages and incomes, and they're driving around on that vehicle, so they got to pay the rate on that vehicle. They got to pay the payments on it. Then they got to pay the insurance on it. And I filled up my pickup truck with gas the other day, $203 to fill up my truck. And I barely drive. So that'll last me 6 weeks, 7 weeks. But some people use that every week, every 2 weeks. You know, you're looking at $400 to $600 a month in gas. You're looking at another $300 to $400 a month in insurance, $400 to $500 a month on the payment on your vehicle. You know, when you're $1,500 a month on just one vehicle, and I see some houses with 2 and 3 vehicles in front of it, and then you think about the mortgage that they have to pay, and then you look at the price of the food in the store, how is everybody affording any of this stuff? So you're telling me that Pool Corps lowered its guidance? No shit. No shit. I mean, I'm not surprised at that at all. That doesn't surprise me a bit. So what are the drivers for outperformance? A much lower interest rate environment than we have right now, and a lot more housing activity than we have now. A lot more housing activity, which we do not have. So no, I think the pandemic brought forward as many pools as you possibly can. I know people here in the pool business and people in the construction and landscaping business, and they all say the same thing. It's like the lights went off. I mean, they've never seen it this bad. It's like the lights went off. So do not hope for the next 2 months to be good for selling pools. If there was going to be guidance being raised, that is done in the third and fourth quarter when the order book for spring fills up. If they're lowering their guidance, it's because their order book is empty. Do not hope for anything there. Potential risk I see is younger generations that are looking to buy homes just don't have the accumulated wealth or savings to include a pool in their home purchase. True. And not only just include it into your purchase. Ask anybody who has a pool what happens to the utility prices when they get into the summer, because you got to run that pump. And if you got a heater, you got to run that heater. It's not cheap. It'll add, well, for me, I think it adds running the pump another $60, $70 a month. And then you got to put all your chemicals in every week. I have a saltwater pool, so the chemicals are light, but still it's anywhere from $50 to $80 every week on the cleaning with the chemicals that are added. So it's not cheap to have a pool. It's not cheap to install a pool. And with interest rates the way they are, very few people really pay cash for their pool. They're usually using some HELOC, some equity line of credit, or some second mortgage on their property. Given the cost of everything else that you have to pay for, who's putting in a pool? It's you still have the elite. I call them elite at this point. The financially elite that are putting in that can put in pools, who can pay for it without a problem. But if you have to finance it, I would say, look, man, there are just bigger problems right now. I honestly, I'm looking at the price of things. I honestly don't know how anybody. I look around and go, where's all the money coming from? It must be coming because the economy is doing well and the markets are doing well and earnings keep coming in. So it must be happening. But it makes me wonder where all the money is coming from. Or has everything is everybody making $150,000 a year now? And I'm still stuck in the 20-year ago thing where I think, that 80 to 100 is a good salary for somebody who's 30. Or am I out to lunch on that? Is like everyone getting jobs at 150, 200,000, and the average income's like 350 these days? Because then that would make sense. Maybe I'm just out to lunch. Maybe I'm so far removed from the job market, I don't know what people are making anymore. Are you still selling 14 calls on ABR when it rises to 14.20? No, I haven't done anything with ABR right now. I haven't done anything. Still have the 14. I've closed the 15s. I had an opportunity to close the 15s at 15 cents. Still sitting on the 14s. But I sold them. I think I got like $1. Like $1.75 or $1.80 or something like that. So I'm comfortable holding them for now. I got GT as well, an engineered assignment on KHC definitely going to outsource from you here. What's your look on ALB? I have no on Albemarle. I have no opinion on this at all. Hitting 52-week lows. 90 has some nice premium peeling IV. Yeah, that I don't know that nice premium is enough when you have something hitting 52-week lows. The question you have to ask right away, you see, when I look at something like this, I always ask, why is it hitting these lows? Why? And if there is no reason, if I can find no compelling reason other than the market must be wrong, then I'm in. But if I can find a reason, I'm out. What's the reason why it's hitting these lows? Then basic lithium products. Can there be a situation of benefit? Well, lithium is, we're not sure where batteries are going right now, right? You've had a lot of the traditional auto companies pull back their EV investments, specifically in battery plants, pulling that back. So when everyone was announcing, every second day there was a $4 billion announcement, $8 billion announcement. We're going to build 4 plants. We're going to build 8 plants. We're trying to secure lithium supply from here, lithium supply from... Then yeah, it just kept going up and up and up and up, but I don't hear any of those headlines anymore. When was the last time you heard somebody, one of the auto companies, saying we're building battery plants? I mean, that was 12 months ago, 24 months ago. Nobody's saying that anymore. What you're hearing more and more often is hybrid. Hybrid is going to be the thing that wins over full battery electric. It'll be plug-in hybrid. Well, if you go plug-in hybrid rather than full battery electric, you're talking about 12 to 13 kilowatt batteries as opposed to 50, 60, 70 kilowatt batteries. You're cutting your lithium demand by 75%. You only need 20 to 25% of what you originally thought. So I don't know that I would be jumping in on lithium right now. That's just my high level thinking. I haven't looked at this company at all. Earn some return on the cash I have set aside as collateral. Do you have any recommendations? If you're in IB, you automatically get a return. You automatically get a cash return on the cash sitting there. How's your Spanish coming along? Not very well. I haven't been keeping up on it. I have other people around me that know the language and speak English, so I think, why should I remember a phone number if I can look it up, as Albert Einstein would say. Very well on the cattle hog spread last year after hearing your thesis. I'm doing my own research. Looks like it's doing the same thing again this year. Cattle supply seems to be slightly lower this year, but the divergence with December contracts still quite high. Seems like the price is definitely out of alignment. What are your thoughts? I don't know. I haven't looked at it. HO RBOB also looks like a seasonal play where HO gains relative to RBOB from July to October. Heating oil gains relative to gasoline in July to October. Heating oil gains. Heating oil inventories, I think, would rise, but I don't know if the price on heating oil, it would make sense that heating oil would rise during the summer months. Inventories would rise. Gasoline inventories tend to fall during the summer months. Gasoline prices tend to rise because of summer driving. And then once you get into the fall, especially if you have an early freeze in the Northwest, up near Boston, New York area, because that's where a lot of the heating oil is consumed, then you can get a drawdown in heating oil inventories with a price boost, and usually you have a drop-off in driving and a drop-off in demand for gasoline, and then gasoline inventories build. So odd that you find it the other way. I've begun trading this since last fall. Curious on your thoughts on this one as well. I've never really looked at the spread between heating oil and RBOB. Is $1 spent in a retail store counted in GDP the same way $1 is spent in online retail? Yep. That's behind my question. As a colleague was sharing some thoughts, UK GDP could be understated because of transition from brick and mortar stores to online. No. The only way that argument would make sense is if retail stores are oversampled and online stores are undersampled. meaning that if there's more activity going on in the online stores, but your sample isn't large enough to capture that, or your 99% of your sample are bricks and mortars, 1% is online. When online's really 10% of sales, then yeah, you might have data that's skewed towards what the brick and mortar stores are saying. I don't know that you'd have that big of a sampling error, but you could have that if that were the case. Last week I went up north and up 7,000 feet above sea level. About 2-3 times a year I like to go hiking, camping somewhere remote, sometimes not. This time I had no internet cell coverage for about 4 days. Have you ever been in a situation like that or similar, meaning being away from the data of the market? Sometimes, yeah. Like if you're flying somewhere, usually you lose the whole day. You got no data in the air. Yeah. If you have, how did you deal with being away from information? Yeah. It doesn't really matter. One day doesn't listen. Most of what happens in a day is noise. Most of what happens in the day is noise. Week over week, you can find a nice pattern, but day to day, it's a lot of noise, so it's no big deal. I know in your course you talk about conviction in your trades, but still, yeah, I don't day trade. I don't do any trade that requires me to sit and stare at my screen. If I can't walk away, and check in every couple hours, then it's not a trade I want to be in. So if I'm buying something and I think, oh, I can't move, well, then I'm doing the wrong thing. I'm now gambling. I'm day trading. I'm looking for 25, 30 cent moves. I don't trade that way. So, any tips on how to overcome this form of insecurity? Well, it's not insecurity. It's probably a necessity that flows from the way that you trade, or you feel that it's a necessity because you're afraid to let go for a couple of days. So what you can do is see what happens to your returns when you make a commitment to, once you make a trade, to you will not trade out of it within 48 hours. Just see what happens, because there's a lot of that goes on, in and out, in and out, in and out, in and out. Buy something today, it's up 20 cents tomorrow. You bought 100 shares. Okay, let me take the profit. And I see a lot of that with people in the market. Just they have no strategy or style. They're just looking to grab whatever they can from day to day. Buy something, and when you buy something knowing that you can't touch it for 48 hours, you're a lot more careful about what you buy. I will bet you that your performance increases. And then if you decide that, okay, my new rule is I can't touch it for 96 hours now, you slowly got to wean yourself off of the day trading. You'll find that your performance improves. So I would say that's one way to overcome it. Do you think investing in private assets is ever suitable, necessary for retail investors? But you do. As soon as you buy a house, you've invested in a private asset. As soon as you invest in education, you've invested in a private asset. So you do invest in private assets. If you own sports memorabilia, if you collect wine, if you collect art, if you collect stamps, coins, comic books, hockey cards, you are investing in private assets. These private equity firms have created products with $1,000 minimums. Looks like a lot of younger, affluent people are flocking to alternatives. It seems to be overcomplicating things for no good reason, because public equities can provide returns that are just as good. Yep, I agree. Is there a particular reason why you talk so much about GM and not Stellantis or Mercedes, who also have huge buybacks and dividend programs? Because GM is undervalued, criminally undervalued. Ridiculously undervalued for its productivity and its profitability. It is significantly undervalued, and it's not just me. Cox Automotive did their mid-year seminar yesterday, and the outlook for the year, they put GM right at the top in terms of expectations of who's going to perform the best. They have GM this year outperforming. Both Carnival and Juniper are reporting Tuesday, so I guess everyone is wrong, including you, because Juniper, as we saw earlier, is July, not June. Not that easy, huh? Been over 700 days since the yield curve inverted. Reliable indicator of an upcoming economic recession. It has been. It has been to date, yes. Are we really headed for a deep and prolonged recession given this prolonged inversion? No idea. Are we already in a recession? I don't think so. Can't understand why the S&P keeps reaching all-time highs almost every week. Same here. Seems overvalued to me. Same here. 5%, 10% correction wouldn't surprise me. Same here. We're on the same page. Unemployment is worse than official numbers projected. Figures seem skewed, likely motivated to present an overly positive view. I'll discount that. Fed should start cutting rates ASAP. What are they waiting for? Try not to go down these rabbit holes, saying, well, they're motivated to present an overly positive view. That sounds like a conspiracy that people are in on, and I doubt that. What should the next move of a common retail investor? No idea. 85 to 90% of my investments are in equity, mostly mutual funds in general. How do you view the current scenario, and what are your projections for the next 5-6 quarters? No idea. Market finds its way to 6,000. Market goes sideways. Market drops to 4,800. All three of those scenarios, I would say, yeah, I can see those happening. Honestly, I have no idea. And that finishes this up.